Hello, everyone, and welcome to our monthly mortgage and market update for July of 2021. We are well halfway through this year, Nicole. I can't even believe it. So let's just jump right in, because I was reading in one of your most recent newsletters about how refinancing right now is a huge deal, right?
Yes, refinancing just got a gift, right? We got Christmas in July. I think there's actually a movie about that. Anyway, yes. we got Christmas in July. The Mark Calabria, who was the director of FHFA, in the middle of COVID, he initiated an adverse market fee. And everybody was kind of looking around going, where's the adversity in this? Like, we're all gaining equity by leaps and bounds. Yet they called it an adverse market fee if people were going to continue to take out equity in a period of time that was unknown. Then we were going to cash in on that is his stance. We were going to build the coffers, if you will, of Fannie Mae and Freddie Mac, and they did that. They increased some of their budgetary line items. And he was recently removed from his position. Great. He had done a lot of things that were anti-homeowner, but pro making Fannie Mae and Freddie Mac private. They wanted to bolster up their books, their fiscal books, and make sure that they could substantiate being a private company. Anyway, long story short, some of the things that he initiated are now being unwound by the new director. And the very first thing out of the gate was the adverse market fee. It got pushed out. And so now we saw an immediate increase. We saw an immediate decrease in interest rates literally overnight because that 50 bips was removed from the cost structure.
Wow, interesting.
Yes.
So I know that inflation, it's hitting all of our pockets, from groceries to gas. So let's switch over now to, what does this new refinancing look for maybe new buyers that are getting into the market? Are those same, Christmas and July gifts, as you put it, hitting our new buyers as well?
Yes, but for different reasons, right? So the refinances just got the opportunity to continue to pull out of their equity, maybe restructure their debt, maybe put themselves in a position where they could invest again. So they just kind of got a gift of lower interest rates. Our purchases also got a gift because interest rates are staying low. In fact, week over week, they actually just went down. And so you're kind of like, okay, with inflation the way it is, typically inflation is the arch enemy of bonds, which in kind of basic terms just simply means when we see high inflation, we typically see higher interest rates. And that's not the case right now. And it's not the case for a lot of underlying economic reasons going on to the strength of the economy right now and what's going on with the Federal Reserve and then purchasing mortgage-backed securities. But all that, bottom line, is that interest rates are still below 3. In fact, they nationwide, they went to an average of 2.88. And that includes a little bit of a discount nationwide, that is. But that's a great trend line is what we're watching.
It's still great out there.
Oh my gosh, it's fantastic.
Yeah. I'm hearing a lot from my clients, I'm sure you are as well, from people either looking to refi or looking to get a new loan, about our bubble, how we're in this bubble. We keep hearing about the bubble. But you and I, we eat, breathe, sleep, live mortgages and real estate every single day. And I keep trying to educate my clients that we are not in a bubble, because they keep thinking, well, these prices can't go higher. Something's got to give. And, XYZ reasons as to that. But to counter that, I say, we already had such low inventory before COVID hit. We already had such strong buyers out there getting these homes under contract super quickly, that when COVID hit and the low interest rates came into play because of it, now we even have a stronger buyer market out there, and still low inventory, historically low inventory. So with that said, that shift, that differentiation between the low inventory and the high buyer demand will not constitute any bubble bursting anytime soon. What are some things that you say to your clients?
Well, we're seeing the same thing, right? We're seeing that the Denver market is, as you know, has been exceptionally low in inventory, especially through this pandemic. But we're naturally a seller's market. We typically run slightly low on what we need historically for inventory. So to see only 3,000, a little bit over 3,000 units for sale at the end of June, well, yes, it's 50% higher than it was in May, but it's still way off from where we want to be to get a balanced market. We rarely actually see a balanced market. So it continues to see our appreciation increase. Now, nobody wants to see appreciation increasing at 17% a year. It's unsustainable, and it keeps the first-time home buyers on the sidelines. Right. but that will slow down. We're not going to see a depreciation or a reversal. What we're going to see is that we're going to take the foot off the gas. It's going to start to slow down in that appreciation, the speed by which. So instead of 17, maybe we're going to see 12 or 10 or 8, or head back towards our normal 6 versus the numbers that we're seeing right now. I mean, some of the things that are supporting this, obviously, is the low inventory that you mentioned, is this still insatiable demand. Even if it gets hotter or cooler, there's still more demand than supply. You also have these extremely low interest rates that we've been gifted, and maybe through the end of the year, based on some things that Fed Chair Powell was saying recently. But you also have all this equity. People don't have to leave their homes, so they can cash out, or they can sell it, or they have options now that they might not have had during other bubble periods, where right now we have the largest amount of equity in our homes. Nationwide, we have over 8 trillion in equity. That's a massive cushion that's not going to allow people to go into foreclosure. So they have options. People have been walking off of the forbearance track. They haven't been falling out or stumbling over themselves. They've been casually walking off and back into a payment history, or simply selling those homes for market value. So there's a lot of things that are continuing to prop up, not only the economy, the strength of the economy, job and wages are going up. We have 9 million open jobs right now, even though unemployment isn't back to normal. It's not for lack of jobs, right? It's for some of the stimulus packages and other reasons that we don't need to go into. But all of those things, that the number of jobs available, still the contained supply, still the increased demand, the low interest rates, this massive amount of equity that's cushioning the market, all supporting the strong housing market that we have today.
Absolutely. And I'd love to touch on the fact that you were talking about the appreciation rates. And just for those sellers out there to keep in mind, they haven't missed anything. It's still a hot seller's market. A lot of sellers are like, I'm just going to wait. I'm going to wait. And I'm like, it's still a hot seller's market, because you might not have, like you said, the 17% appreciation year after year. Maybe we'll go down to 10, 12, 6, what have you. But keep in mind, that's still appreciation. You're still gaining that equity in your home. So a lot to think about. And
you still had the 17 from last year.
I know.
It didn't go unnoticed. You still had it. Your home price was building up. It's just going to build up slower, but you still captured that gift of equity that we all received in the last year.
Absolutely. And if you do happen to want to cash out on that gift of equity and sell your place, give me a call, Marybeth Brush, at 720-878-6236. And Nicole, I will have all your information for anyone out there right below this little YouTube video, your email and your phone number for anyone looking to refinance, obviously with the amazing refinancing packages going on, and to get any new loans to buy those new homes out there. Nicole, thank you so much. We'll catch you next week.
Absolutely. Bye-bye.